To earn a decent return, you need to invest in equity stakes of businesses, either directly or through mutual funds. But you're not sure about all the jargon. What is the market? What's the index? What is the difference between the Sensex and the nifty numbers that everyone keeps talking about, right? Let's talk money. Hi, I'm Hansi. So let's recap investing. You can lend money to a business on the promise that it will pay you regular interest and return the capital to you at a preset date. Or you can take a minority stake in a business, becoming a silent partner. That's called investing in equity or in stocks. You now share in the profits and losses in the proportion of your stake. You cannot tell the business on how to run it, you cannot demand dividends, and you cannot ask for your money back. Ever. Now, if you don't like the way the business is being run, or you need your money back for any other reason, all you can do is to sell your stake to somebody else. You will find potential buyers for your equity stake at the market for stocks, which is the stock market. It used to be a physical place in most big cities around the world, but now it's all through computer networks, kind of like the internet. At any given time, you can see how many people are willing to pay how much for each share, which is their bid price. You can also put in a price at which you are offering your stake, your offer price. Now, both the buyers and sellers should have access to all the relevant information. Neither of you should have access to any inside information, which is illegal. So the difference between the bid and the offer should be based on different analyses of the same facts, or perhaps different outlooks. Some people are naturally more optimistic than others. Some are bargain hunters, while others like blue sky, right? The technical terms for these are value and growth. We will discuss this in a future video. Anyway, the price at which the last transaction actually happened is the market price. If you multiply the market price by the number of shares out there, you get the market capitalization for that business, which is basically the price that someone would have to pay to buy the whole business. Now, here is the complicated part. These prices fluctuate not only because of factors related to that particular business. They could fluctuate because of something happening at a competitor, or at the industry level, or the national economy, or some other global issue. Some of these factors affect some business prices, while others affect all businesses. They're also called sentiment factors. Remember, there are thousands of businesses listed on the stock market in every country. To be able to easily track the sentiment for various types of businesses, some people invented the concept of a market index. Imagine a hypothetical basket with one share from each business in the market or the industry trying to measure. In India, the two most tracked indexes or indices are the BSE Sensex and the NSE Nifty. The Sensex has the largest 30 stocks listed on the Bombay Stock Exchange, the BSE, while the Nifty has the largest 50 stocks listed on the National Stock Exchange, or the NSE, weighted by size. Similarly, the Dow is an index with the largest 30 stocks in the US. So when you hear or see the Nifty going up on any given day, that means most of the stocks included in the Nifty index went up that day. So you know the sentiment of the market in one number rather than having to check the prices of all 50 stocks individually. Pretty nifty, eh? Now, there are other indices that include the price of the largest 100 stocks. They represent the large caps. The next 100 stocks by size are the mid caps, and the rest are usually called the small caps. The index that has the largest 500 stocks is considered to be a pretty complete representation of the stock market of that country. So there are well-known indices like the S&P 500, the Nasdaq, the FTSE, the Nikkei that are much more broader based than the Sensex, Nifty or the Dow. Now, size is just one factor to create an index. You can actually make an index of any factor that you're trying to measure. You can also make an index by industry, say all the stocks of car manufacturers, of all the banks or the financial services companies. The joke is that there are more indices than stocks. But you know what? You can ignore most of them. In summary, I hope you have a better handle on some of the key concepts. The stock market is an online market for stakes for large enough businesses listed on the exchanges. While the people can make any bid or offers they like, the market price is the one where people actually traded. And the market price multiplied by the number of shares is the market cap, or what you would pay for the whole business. And then there are indices that represent the largest 30 or 50 or the largest 100 all the way to 500 businesses, which represent the market, divided into large, mid, and small cap. So now, are you ready to invest? If you still have questions related to any of these concepts, put them in the comment section below. Or you can post anywhere on social media tagging The Money Hunts.